Class Criteria 3 focuses on the application of management accounting techniques. You need to calculate costs using appropriate techniques of cost analysis to prepare an income statement using marginal and absorption costs. A management accountant will want to know the marginal cost of a product. The marginal cost is used to make business decisions. The marginal cost is the variable cost of producing a product. The cost of production excluding the fixed cost. The marginal production cost of an item is the direct materials cost, direct labour cost, direct expenses cost, and variable production overhead costs, all added together. The important thing to note is that the variable costs of production increases as the volume of production increases. If 1 pound of sugar is used to make 1 cake and 2 cakes are needed, then the variable cost would be the price for 2 pounds of sugar, because 1 pound is needed for each cake. Fixed costs generally remain unchanged within a time period, regardless of the volume of production. The fixed cost to bake the 2 cakes will remain the same because both cakes can go in the oven together. In fact, the fixed cost will reduce per unit because it will be shared between the 2 cakes. If goods, in our example the cakes, are not produced, the marginal costs will be avoided. Our manufacturer will not have to buy the extra sugar. In another example, if someone making roasted peanuts decided to reduce production, they will not need to buy in as many peanuts. Therefore, the marginal cost of the roasted nuts will be reduced. Another way to look at it is to say that marginal production cost is the part of the cost of 1 unit of production, which would be avoided if that unit were not produced, or which would increase if 1 extra unit were produced. Marginal costing is an accounting system in which variable costs are charged to cost units and fixed costs of the period are written off in full against the aggregate contribution. Again, note that variable costs are those costs which change as output changes. These are treated under marginal costing as costs of the product. Fixed costs in this system are treated as costs of the period. Marginal costing is the principal costing technique used in decision making. The key reason for this is that the marginal costing approach allows management's attention to be focused on the changes which result from the decision under consideration. The contribution concept lies at the heart of marginal costing. Contribution can be calculated as follows. Contribution equals sale price minus variable costs. The idea of profit is not a particularly useful one, as profit depends on how many units are sold. For this reason, the contribution concept is frequently employed by management accountants, because contribution gives an idea of how much money is available to contribute towards paying for the overheads of the organisation. At varying levels of output and sales, contribution per unit is constant. And at varying levels of output and sales, profit per unit varies. Finally, absorption costing. Absorption costing is a method of building up a full product cost by adding direct costs and a proportion of production overhead costs by means of one or a number of overhead absorption rates.